I was going through your presentation. You are building a strong argument to have some gold in the portfolio as far as investors are concerned. Last time I remember your legendary call on real estate space peaking out 5 years back, way ahead of the consensus. Now you're talking about gold, but there are parts of the market which are already turning bullish on it. You are making a bigger macro argument. Tell us, why do you like gold right now?
Thank you, Ajay, for hosting me. And I've been talking about some kind of allocation, a portion of allocation into gold for last 2 years. We wrote in our annual letter. And if you look at the way stage is being set up on the macroeconomic environment, you have a huge debasement of currency, and especially if you have to look at a US dollar, which usually act as a proxy of gold. There's a huge debasement, 7x increase in the central bank balance sheet of Federal Reserve in last 10 years, and close to 50% increase in last 9 months or so, 6 and 9 months or so. And that's a huge size, and so is the case in ECB, the expansion of the balance sheet. So that is a one which has changed significantly. And the second thing is that the world is seeing a perpetually low interest rate and a negative interest rate. Now it's been close to half a decade where the experiment of the negative interest rate has happened. And also you look at, see, what has changed is that the seed of the deglobalization has sown in for last 2 years. And what we are seeing is this weakens the US dollar's position, because US dollar is a choice, the currency of the choice for the trade. So when you add these arguments together, and along on top of it, gold as a metal has only grown from a supply side as only 1% per annum for the last decade or so. So you add all these things together, you have a very low interest rate, a high probability of US depreciation, and also which makes a case that the money would flow into an asset which has stood the test of time for the investors over a period of time, versus the asset which is it's not as stable at this point of time, which is a US dollar at this point of time. And if you look at from a central bank's position, the gold outstanding to the central bank's monetary expansion to the monetary outstanding reserves is lowest at this point of time. So it makes all the more sense to look at gold as a portion of allocation for any investor at this point.
Manish, fair point. In fact, macro watchers are saying, and you also talking about it, that the setup seem to be suggesting that gold may be in for a decent time. You have analyzed the macros when gold starts working for a very long time as well. Not only last time we saw it went above the $1,800 mark and then came back. You've seen macro phases when gold works and then it goes on sideways, then again works. What's the setup looking like right now? Why are you so bullish on it?
Yeah, this is one of the most interesting and millions and billions dollar of question. What everyone would have in their mind is that why gold now? And same would have been argument 5 years back or so. So what is the most interesting part in the gold theory is that you have a situation when you have seen what we have witnessed now is that a negative interest rate, a low interest rate and a negative interest rate. The gold does its spurts and gold shoots up when you have a negative real interest rate. And there's a difference between a negative interest rate and negative real interest rate. So look at a situation where the US Treasury was giving you a positive yield for a considerable period of time, and that was a issue why US did so well, and US dollar-denominated assets did so well, and US venture capital or US equities did so well, because you have a dollar-denominated asset which is doing very well and giving a positive yield. And now we are in a situation at this point of time where the US negative is giving you. So how do you calculate a negative yield? Is a 10-year Treasury minus the US CPI, which is the consumer price inflation. And I'm referring to US back and forth only because that usually the world has used US dollar as an alternative to the gold for some point of time now. Till that 1971, that whole debasement that happened on the US side. So you have a situation now that we are going to see a negative interest rate scenario, a real negative interest rate. And if you look at the situation in 2011 to 2012, we saw negative interest rate, and there have been 7 or 8 occasions in the world when you see big spikes in the gold. Because look at what is a gold? Gold doesn't give you any kind of yield. Gold has a storage cost. So if the world and the monetary order gives you a negative yield, or more or so, a real negative yield, then it is a time for gold to shine. And we are seeing the conditions which are getting very, very finely in a box which is hinting towards you that there will be a spurt in the gold prices.
Manish, let me play the devil's advocate. There's a very, respected and very widely covered author, macro strategist, and we track them very closely, and making a case that what if the central bankers start selling gold because they are holding big portions of gold themselves? What happens to gold prices? Is that a risk? How do you analyze this argument?
I'm not too sure that why someone would be framing an argument that there can be a huge central bank selling of the gold by the central bankers. If I look at the data that last decade or so, they are the net buyers. In the last calendar year 2019, that's the updated data, they bought close to 600 tons, which is the highest in the history of the central banks. The size of gold, what they have accumulated. My sense is that it's close to now 3,500 tons. That's a total accumulation of gold which is done by the central bankers. When central bankers buy gold, and there are periods when they sell a gold. So what central banker, maybe anyone sitting in anywhere, maybe RBI also has an option to buy an asset which gives you a positive yield, and which was a US Treasury for some period of time. And even in the last decade, when US gave you positive, people kept on building up their gold reserves. So if there is an argument that because of a liquidation event, the central banker could sell some of its gold, then all the more reason, because gold thrives when there is a chaos. And we are building up a case, and you are seeing a situation where we are talking about a real negative interest rates. So all the more case that the probability of you losing money holding a dollar asset is significantly higher versus owning a gold, and where you should ideally see a positive return on gold. So if there is a corresponding sale by a central banker, then I see a situation that selling can easily get absorbed. There are enough buyers, and many and more buyers. The financial markets are turning to a gold. And if you look at it today, close to 187 or $90 billion of ETF money is into the gold ETF. So you would have enough buyers of the gold rather than if there is a big seller even. So I would not make a case, and I would doubt that why that case would be made of central bankers selling gold. In fact, it should be a time when central bankers would be holding golds.